Okay, we're live. Good. So we're going to do 3 questions today. We're going to get all caught up, hopefully. The plan is Thursday. We're going to do GST, HST for about a third of the class, and then the last 2 thirds of the class are your chance to ask questions before the midterm. So it's sort of like a review session. So if there's areas that you want to review, then bring the question and ask. If you want, email me ahead of time if there's specific questions. What I'll do is if there's a common question across everybody, I will take that one up. Okay? Is that fair? So if you guys all send me, ladies, gentlemen, if you send me a question that says I really had a problem with this one, can you explain this one again? And the same question comes up a bunch of times. I will use that as one of the two questions that we take up for Thursday. Okay? Fair enough? So very much HST, GST on Thursday, and then the last 2 thirds that we generally take a review session. Okay? Pretty good with that? So it gives you a chance to kind of catch up on anything that you don't quite understand. Not big enough. Okay, the quiz for today. Any questions on SR&AT quiz? Any questions on the SR&AT quiz? That's not very well placed. There you go. Ladies and gentlemen, any questions? Jennifer? Number 8. Things acting up already, eh? Okay, 8. Which of the following are true about SR and ED credits? They are taxed in the hand of the recipient. They are, right? Investment tax credits, what happens is when you get them, they're effectively taxed by virtue of they're taking it into income or reducing a cost pool somewhere else. So if you have a 0 in your R&D pool, they can theoretically be taxed in your hands. So we're going to look at that today, how that works, okay? Secondly, they can only be claimed as tax otherwise payable. For this course, that's true. In 18 months, not by CU again, 462. There's special rules for CCPCs, Canadian Controlled Private Companies, that investment tax credits can be refundable, but for purposes of this course, the 20% non-refundable is what that's what you should know, okay? But you will see again in 18 months, if somebody's really smart and seen this before, you'll actually see there's special rules that's not totally true, but for purposes of this course, you have to have a tax payable to use the investment tax credits to reduce your tax liability to 0, and they don't create a refund. So they can drive payable negative. The professor might put a little check mark there. That's because for now you think that's false, but it can create a refund. Okay? But that's for when you see me in 18 months. They ensure fairness across all taxpayers. If you think any tax initiative creates fairness across all taxpayers, I wish you luck. Everybody's going to complain about something. So there's some people who probably argue this isn't fair. Some people think it's great. Okay? So the first 2 are true. The other 2 are depending on the day of the week who you are. Okay. Pretty good? Any other questions on the quiz? Yes?
Explain the last question.
The last question? So question 9, when I wrote this, all I did was, they're all correct, right? There should be 5 of them. So all I did was, when I used to be the tax person for a large research company, this is what you would find. These are the 5 things that if you're doing a T661, or 661 now, these are the things that you would claim as research and development expenses that would go into your research pool. Okay? Professor Markle talks about R&D expenses. What they do is they go into a special pool. Section 37 is written just like the CCA pool and the CEC pool. It's basically literally written like a definition of add this, add this, add this, subtract this, subtract this. So guess what? All you got to do is, these 5 types of expenses are the 5 types of things that would go in there if you don't do a proxy election. Okay? And again, 18 months from now, we'll talk about what that proxy election is. But for now, this is what you need to know. These are the types of things that would go in: salary and wages, materials consumed, capital costs of assets used. So basically, this is the one time that you're allowed to deduct the cost of capital assets directly off your P&L, off your tax returns, right? So you buy a piece of equipment for $100,000. Generally speaking, Section 18 says that's capital, you can't deduct it. Section 20 says add it to your CCA pool. Section 37 comes along and says, notwithstanding those rules, If it's R&D, then you can actually deduct it as an expense incurred. Okay? So that's why the third one is correct, obviously. The cost of overhead. So what happens is if you have overhead expenses, what you can do is you can actually allocate them. Okay, this portion of the people that are related to supporting the R&D facilities, you can actually deduct those as well. And that's again, if you do not claim the proxy amount, which again, in 18 months we'll talk what that means. But for now, that's good enough for what you need to know. And then the last one is you pay money to a research company that basically does some work for you. As long as you can exploit those results as related to your business, then you qualify as an amount that you can put into your R&D pool. Okay? And remember, these are only in Canada. Okay? These are R&D expenses only in Canada. Okay? Foreign expenses, you can't put into the pool. They're deducted like any other normal business expense. Right? Under section 37.2. 37.1 is the pooling of Canadian R&D expenses. The reason is the government of Canada wants to promote R&D in Canada. That's the way they do it. They say, hey, we'll let you put it into this pool and do this flexible treatment of your expenses. And why is this so important? Why do you think this is so important? Less so now that we have a 20-year carry forward. When I was learning these rules, the carry forward period was only 7 years. So 7 years comes up fast. Now it's 20. It's a little bit more easy to see that people will use their loss carry forwards eventually. 20 years is a long time. 7 years, not so much. But why is Section 37 this pooling concept? Why is that a good thing? Jennifer?
It's because the amount is deductible, but in addition to that, you can also get a credit.
Okay, so Section 37, yeah.
The deduction pools are good.
Right, that's the key. The ITC is the second piece of the puzzle, right? The investment tax credit, there's two benefits to being research and development. Well, there's actually three. First one is they go into this pool, and you don't have to deduct them. So what happens is, a lot of companies, their first 5 years, 10 years, they lose money. Deductions don't mean anything to them. But the problem is if you deduct them, they go into the loss carry forward pool, especially if the carry forward is only 7 years, you can expire real fast. Right? What happens now is you put them in this pool and you don't deduct them. Whenever you want to use them, you use them. So let's say in 10 years you start making lots of money, there's a giant amount of money, you can just deduct all at once. No problems. The second benefit of R&D is, as Jen's talked about, is the investment tax credits. And that's where the government basically helps subsidize part of your research and development. For now, what you need to know is that's 20%, right? So 20% of eligible research and development expenses for all companies, right, would be eligible expenses would be going into this credit that they basically give you to reduce your taxes payable, which is nice. It's like a government subsidy. And obviously, when you get a subsidy, you have to remember there's a blowback to that which you have to pay back. You have to basically include in your income or reduce your expenses the following year. Anybody know what's the third positive thing about research and development expense? Anybody know? There's one other one. The book does. The book mentions really briefly somewhere in there. Some provinces have special rules for research and development expenses as well. So there's actually what they call super allowances and things like that in certain provinces. So you just need to be aware. There's the federal Section 37 deduction, the federal ITC, and then thirdly, you should look and see if there's any provincial benefits up there, right? Because a lot of the provinces are trying to get people to do R&D in the provinces. The whole idea here, ladies and gentlemen, is R&D is a good thing. You need smart people, lots of jobs, all that kind of good stuff, right? People make lots of money, you can pay scientists lots of money, there's lots of spin-out benefits, lots of different companies generated. Look at RIM. RIM was basically an R&D company when I was here 25 years ago. Now look at it 5 years ago. Bad example now, but look at it 5 years ago, and it was a money maker, and everybody was making lots of money. The government said, "Ooh, we love more RIMs," and this is how they do. They put these certain rules up there. Okay. Any other questions on the quiz? Thanks. Remember, you should know how to do quizzes. Okay. Remember the midterms too. Friday, right? Okay. Covers up to today's material. Okay. Anybody else? Anything else in the quiz? Going, gone. Okay, let's, what we're going to do is we have to do 3 questions today. So we are going to go to section 1. You guys are number 1. Yay. 11-6. Okay. Okay, so problem 6, 11-6. Okay. Who wants to start me off? How are you going to approach this question? Somebody have a heard from today? Okay, read the required. Okay? Guess you got to be able to see the required before you read it. Compute the tax payable for the company for 2011 tax year, including provincial tax, show all calculations. Okay, Jeffrey, so what did you do?
I started with, this thing started with, so the schedule, I guess, A, B, C. So I went with the schedule.
Okay, so remember what I talked about the other day. You only need to do 3A, 3B, 3C. We tell you to do that, right? This is just saying compute tax payable. Okay?
So you start with division B income because you have it.
Okay, right. Well, you have to determine division B income what?
Because you might make adjustments to it for capital income purposes.
Okay, the most important thing is certain deductions in division C are relying on division B income. So you have to go through the process. You're going to calculate division B income. And only use the 3A, 3B, 3C stuff if we ask you for it. We don't say use the ordinary rules, don't use it because it takes more time. It's just, you gotta think a little different. This one is calculate tax payments. You're going to calculate division B income. You're then going to calculate division C deductions. Remember, division C is all those deductions. Come up with taxable income. And then you're going to calculate taxes payable on the taxable income. Jeffrey, correct? Okay, so go ahead.
So first, you start off with division B income.
Yeah.
Which is 264,000.
Okay, so consulting business. So consult business income. So remember, what somebody did, you've got the number here. Somebody went through and did the reconciliation, add, subtract, accounting income versus taxable division B income. Somebody's done that here. That's why we tell you division B, right? So somebody's already done a lot of the work. They've already done CCA. They've already gotten rid of depreciation amortization. We've just given you that number. Remember last class, we actually had one step back where you had to calculate the business income and put it into the division B stuff. Okay, now we've got that as an input. Go ahead.
First, I guess you gotta add stuff to the division B income because we have all these royalties.
Yep.
Like, I would add the royalty income to division B income first. I also add the non-foreign.
Okay, hang on. So royalty income is 10. That's Canadian. Yep.
I would add the dividends because dividends are usually included.
Okay, so you're doing Canadian dividends,
Yes.
taxable Canadian dividends. Remember, there is a type of dividend that's non-taxable in Canada. Remember what that is? There's one that doesn't even show up here. Jeffrey?
Is it foreign dividend?
No. There's what they call a capital dividend. Okay, so if they tell you there's a capital dividend, it's non-taxable in Canada. Again, you're going to hear me. You're going to hate this expression for the rest of the day because it happens a few times. In 18 months, you're going to be really smart when you learn all this stuff again. And you're going to learn all this CCPC and private company stuff. You'll understand what a capital dividend is and why they pay it. But suffice it to say, capital dividends, if you see somebody here, capital dividends, you don't include it on the schedule. It's excluded from tax. Okay, so this is taxable Canadian dividend, which means you're going to do what with it?
Add it back to the
Right, so up there, ladies and gentlemen, you've got taxable Canadian dividends from non-connected companies. It's 5, right? And again, 18 months, you're going to know the difference between what connected and non-connected means. Doesn't mean anything to you right now, okay? But again, it's all part of a different scheme that we're going to look at. Part 4 tax, okay?
I would add the taxable capital gains tax, even though I don't know why they didn't include it.
Taxable capital gain is how much?
Why didn't they include the taxable capital gains? I thought that was part of the in like this.
Pardon me, sorry?
Like, I don't understand why taxable capital gains isn't part of the division B.
It is.
Like, no, I meant like it's separate.
No, don't forget. The first one is division B income from the consulting business.
Oh.
Remember, you got to source things, right? So there's a business over here, and then there's other things that we do. So you can have 4 businesses. So we can have 4 lines here: income from consulting business, income from rental business, income from a different thing. All that you have to do that reconciliation of accounting income, taxable income. You have to do that each line. They come up with the business income, and then it go on to that schedule. Okay? So don't get confused. There's calculating division B income of a business, and then there's calculating division B for the whole company, right? So this is a company, right, ladies and gentlemen? So the company, you take the businesses, put them together, and then you add anything else, like the division income, other expenses, to come up with division B income of the company, the entity. Everybody understand? There's a big difference there, right? Okay, so now we're doing a company. So this is a company here. Take a look. Bulk Baltrop Limited. That is a company that has different things going on in its world. You have to account for all those things when you file his tax return. One of them is a business, consulting business, and the good thing is they've done all the hard work. They've told you it's 264. So somebody literally said accounting income was this much, to add back depreciation, take away CCA, all these meals and entertainment. Somebody's already done all that and given you 264. Don't question it, it's right. Go on, okay? Jeffrey? What else you got? So taxable capital gains go into Division B income.
The UK dividend.
Yes.
That too,
Okay, so we've got UK non-foreign affiliate dividend income of $20,000. Okay? I won't say 18 months. 2 years from now, if you come back and if I'm teaching the master's course, there is what a foreign affiliate is. And there's probably 300 people in Canada who actually understand what they are, so don't get too fussed about it. All you need to know is if they tell you it's a foreign affiliate and you get a dividend from them, they would be deductible under Section 113. How do you actually understand what a foreign affiliate is and how they're deductible is a whole course that I taught a few years ago, and it's quite involved, but it's literally, if you want to be a tax specialist, make a lot of money, go into that stuff. But literally, there's probably 300 people I've ever met who know how to do that stuff, okay? But for here, it's a non-foreign affiliate, so don't worry about it, okay? But foreign income, you included in income, okay? Did anybody say anything that foreign income is excluded from income? No, you got to put it in, okay? What else? Jeffrey? Oh, sorry, Jeffrey. And make sure, non-foreign affiliate dividend income, the $20,000 is the gross number. So they paid you $20,000. They took $3,000 of tax off. You probably got a cash check for $17,000. Okay? The problem is, what happens a lot of times in your accounting records, somebody just got it in cash and credited income for $17,000. When you do the tax return, what do you have to do? You have to take the gross amount. So what you have to do is actually change the accounting a little bit there. So you have to increase the income amount by $3,000, right? To make it the gross amount. So the $20,000, the gross amount is what you include in income, not the net. Because we're going to deal with the foreign tax credit. The foreign tax you pay, that is a foreign tax credit, not a deduction. Right? You'd rather have a credit than a deduction. Would you agree with that? For a company, you'd rather have a foreign tax credit than a deduction. Why is that? Why would you rather have a foreign tax credit than a deduction?
Well, because your foreign tax credit, it deducts all of your taxable income. If you have a deduction only coming from your business, so you still get taxed on your percentage.
Your wording is a little bit off, but I think you get the right idea. The foreign, if it's a foreign tax deduction, all it is you take your income minus the amount and you have the net amount you pay tax on. So you're paying tax at 38%. So you effectively save 38% on the dollar. A foreign tax credit is dollar for dollar. So when you get a foreign tax credit of $3,000, that reduces your federal tax liability by $3,000, dollar for dollar. So you'd always, as a company, prefer a credit to a deduction, right? Which is the flip to an individual. Individuals prefer deductions to credits, and we'll talk about that in another course. Okay? So key is, remember you got to use the gross number, not the net number. Okay? So the 20 number. I didn't mention, the other question is taxable dividend from Canadian corporation, $5,000, right? Okay? Remember that's a gross number too. And there's no gross up. You only gross up for individuals. Remember you do that dividend gross up concept? Doesn't apply to companies. Okay? It only applies to individuals. So a company gets $5,000, that is what they report. An individual, you get a dividend for $5,000, what do you report? You remember? What do you report as individual? Oh, 504, right? So 5/4. So you gross up, then you do the tax credit. Everybody remember that? There is no gross up for companies. Okay? All right, what else? Anything else? Jeffrey? So take a look here. We've got income, donations, unused foreign tax credit. Okay, so I think we're good. So division, B income, which equals 274, 280, 300, 306. Okay, good. Can't believe I didn't add that right, but that's okay. You don't fail because you can't add in this class. Okay. Okay, what do we do now? Somebody else? Let's do that some. Jeremy?
You can take donations off and net capital losses.
Okay, so help me do that, Jeremy.
All the donations calculate or 75% of Division B income.
For donations, remember they have a 5-year carry forward. I always like to put amount paid plus carry forward. In this case equals, how much did you pay? 100,000. No carry forward equals 100. And then the lesser of, what's the other one?
75% of Division B, which is 75 of 5,000, 228,000.
Hang on. I already write poorly. You make me go faster, Jeremy. It gets really ugly.
That's 228,750.
Look at this thing. It's got a mind of its own. 228. 228 what, Jeremy?
750. So that's just 100,000 less.
So obviously the lesser of is 100. Okay?
Then you also take off the net capital losses, which is also the lesser of intangible gain in the year.
Oh, come on. All right, what happened there? Anybody want to help me do this? This is really bizarre. Here, let's do this. There we go. I don't know what I touched. Don't. This is why I don't like using this thing, but that's okay. Professor Markle, I didn't mean to slight you with that. Okay. Net capital losses. Okay?
And that's the lesser of taxable gains in the year.
So remember, what Jeremy's doing here is, with donations, if you just put the 100, you're going to miss a half or the 2/3 of the marks. Right? The 100, you need to do the lesser of calculation, right? Because sometimes something's going to happen that you're going to be wrong. So it's important to make sure you know it is a lesser of. Similarly here, this is net capital loss claim is always the lesser of. Yes?
Taxable capital gain in the year.
Yep.
6,000.
Yep.
And the net capital loss carry forward balance, which is 12,000.
How'd you get that?
That was given.
Okay, so where are we here? So they tell us here, net capital losses for 1999 are $12,000. Okay, yeah, Andrew.
If converted to current day,
Remember, 1999 was a different inclusion rate,
Okay.
right? So what you gotta do is you gotta adjust it. So Andrew, how do you do that?
you gross it up back to full amount of the capital gain, so 12,000 times 4 over 3.
Remember, I believe the easiest way to do this is, remember, it was 12,000 3/4, so bring it back to the gross number, so multiply it by the reciprocal, 12,000 times 4 over 3,
And then times a half.
and then times it by today's inclusion rate, and you'll always be right. And that, what's that number come up to?
I believe it's 8,000.
Is that 4, 16, 8? Yeah. Okay, so the lesser of those is? Right, so lesser of 6 and 8 is 6. Okay? Everybody get that? Okay, so that gets you to taxable income, right?
Don't we add back also, something like the dividends and something?
The which one, sorry?
Dividends of 5,000.
Oh, I didn't do, hang on here, sorry. So where am I here? Sorry, what did I do? Am I jumping ahead here? Okay, yep, that's a good one. Okay, so you're going to take off your dividend deduction. So hang on here. Section 112, dividend deduction. Jake Wold?
5,000.
I gave you the answer, I just didn't, I was doing the number in my head. And I remembered the 5,000, but it's still the right number. Taxable income equaled how much?
194.
Okay, so taxable income is 194. Let's talk real quickly. It's not H2, it's 112. Jeez. So that's section 112. Okay? So remember, there's two special sections in the Act. Section 112 deals with Canadian dividends. Section 13 deals with foreign affiliates. Okay, as I said, foreign affiliates, that is 2 years, 3 years from now. That's close. A lot of fancy stuff. So let's call that postgraduate stuff. So just assume if we tell you foreign affiliate, if it's deductible, just deduct under section 13. Section 112, where am I over here, allows you to take a dividend for Canadian dividends. Anybody know why? Why are we doing that? Why do they let you do that? So I received $5,000 from a Canadian company now that I'm taking it back off to the chance.
They don't want the business to
That's
go.
the chance.
They They don't want an individual to be taxed twice.
Well, they don't want the corporate chain to be taxed twice, right? So they know what happens here, right? So Bryce, you want to try to explain?
Oh, well, it's already, like, tax is already been paid on that, so dividends are paid.
The corporate group is paid tax once when you earn it, right? So when all this income we're making now, we're paying tax now. Then it goes to retained earnings. When you pay it to an individual shareholder, the corporation only pay tax that one time, right? Why does it make sense? Because you want to be fancy and have 10 companies. If you look at Magna, they have 10 layers of companies. What would happen if you paid a tax every time it went out to the company chain? There would be nothing left by the time you got to the top. The government's saying, no, that's not fair. So as soon as you stack companies on top of each other, what they say is, don't worry about it, it could flow through tax free. So what happens is, you pay a dividend from one company to the next company, if you include the income, but you get to deduct it, that next level up. And similarly, all the way up the chain, all the way until you get to the top company. Only when that top company pays it to an individual, you have the tax credit, all that gross up stuff happens, and that's where you get integration again. Okay, everybody get that? So the whole idea is to make sure that you can do whatever you want between the companies. Again, 18 months from now, there's a special Part 4 tax that deals with this stuff, a little bit more. So this is all to tell you, come back again in 18 months. It's an interesting course with a lot of fun stuff in it. Okay? But suffice it to say right now, the 5 goes in as an income, goes back out because it's going to get dividend deductible under section of the law. That's all you need to know for now. Okay? Pretty good? All right, so now we have taxable income. That's great. At 25 cents, get you a cup of coffee. What do we do from here? Calvin?
Well, I was just actually going to ask, you actually have to write like section 112 when we do it on the exam, like to show that.
No, you could say dividend deduction, a corporation or something, Canadian dividend. If you say Canadian dividend deduction or something like that, you're okay. Okay. But I mean, basically, you need to say somehow that what it's for. Corporate deduction, Canadian corporation dividend, something like that, deduction, then you're okay. Section 112 should be different. Right, something like that. You're on the right here, Janish?
You got to calculate your abatement.
Okay, so hang on. So you're going to do the abatement first?
Oh, sorry, yeah, first you got to obviously do the tax. After you do the tax, you do the abatement.
So the first thing you're going to do is federal tax at 38%. So 38% of 194, okay, equals what's that, Janish? 73.72. Okay, then what do you do, Janish?
Okay, and then so the abatement.
And what we're going to do here is we're going to do a little number.
Schedule.
So we're going to do a little schedule, right? Make it easy for the marker, everybody. Ladies and gentlemen, make it nice and easy. Make the marker smile and say, I like this person. Okay, and what is the abatement meant to do? Hang on before I carry on, Janish. What is the abatement meant to do? Why is the government giving you this abatement, Jeremy?
Income is attributed to each province. The abatement is only available to the province.
So the good thing is, if you understand what the abatement's meant to do, it's not that hard to figure out what the calculation is, right? So all they're trying to say is, the federal government, we usually like to grab all the money, but because the provinces like to do some taxing too, what we're going to do is we're going to give you a spot for the provincial government to take up to 10% of the taxable income earned in a province and tax it. So therefore, the abatement should be 10% of the income earned in the province because that's what the provinces are going to tax. That's what we're going to see right now. That's what the abatement calculation is. If it's not earned in a province, there's no abatement because there's no province taxing it. Right? Makes sense? That's all we're going to do. Okay, so Janish?
Yeah, okay, so I guess you kind of write it out by like provinces and then the US, so like BC, Alberta, and then I guess total Canadian, and then US, and then I guess total. And then, so you write out your gross revenues, so BC.
What happened there? Look at that. That's weird. Okay, so you're going to do gross revenue.
Yeah, so obviously BC is 3 million, and then Alberta is 3 million, so total Canadians.
So these are all in thousands, ladies and gentlemen, okay?
Alberta's 3.
So it's 3,
Yeah, Canadians.
6.
6, and the US is 4.
Okay, sorry. So you know who wrote this question, then was really lazy on the math. Look at that. 3, 3, 6, 4. It's not too hard to do the percentages. So you can do the percentages, Janish?
Yeah, so obviously 30, 30, 60, and 60. And then
Don't need to worry about that because the 60 doesn't mean anything yet, right?
Yeah.
40 here?
Yeah.
Yep.
And then salaries, then the wages, so BC's 500 grand, Alberta's 300 grand. So like 800 is your total, then US is 200 grand. And again, your percentages are like 50, 30, 20. And then the percentage calculation is like, for BC it ends up being 40%.
Hang on, let me just do this. 1 plus over 2, so this is 1, this is 2, 1 plus 2, so this is going to be 40, 30.
And then 30 for US and 70 for total Canadian.
So what this tells us is 70% of this company's taxable income will be subject to tax in Canada. Therefore, the abatement should be 70% of the taxable income of the company. Yes? That's the calculation. That's the nice thing about it. And when we talk about the foreign tax credit, you're going to see there's some logic to what we're going to do too. Okay? Okay, so Janish, what are we going to do with that 70%?
Yeah, so it'll be like the 10% of 70% of the taxable income of 194.
Here, let's do this. I'm going to do this. Hang on. Do it like this. Times 10% abatement. Ladies and gentlemen, this is going to get posted, so I wouldn't write too crazy if you don't want to. So it's going to be 70% times 194K times 10%, which equals? Which equals what's 70%?
Oh, which equals, yeah, 13,580.
Okay, so 13,500. And while we're on this schedule, there's another couple easy marks you're going to get. What are you going to do? So we've done all this work. We already know something about provinces here. So what do you want to do?
Allocating your income?
So you're going to say BC, taxable,
Yeah, so BC is like the 40% of 194.
was 40% times 194.
And Alberta's 30. So BC ends up being 77,600.
76, 77.
77,600.
Okay, and then
And then Alberta ends up being 58,200.
okay. So ladies and gentlemen, we now have the provincial taxable incomes, and we now have the abatement number, right? Okay. This is a simple example. Alberta doesn't quite work like this. What Alberta does is they actually have a separate tax return. And you actually go and fill it out, and there's differences between the province and the federal. That used to be the case in Ontario, but the good thing is Ontario did away with that. So for now, just basically they're telling you just use this basic example, but that's not quite correct. So your abatement you're going to plug in here is 13.580. You're going to go net federal tax, which equals
60,140.
60.140.
Yeah.
Okay, and what do we do now?
You gotta deduct your non-business tax credit.
Okay, thanks, Janish. Okay, why do we do the non-business first? Okay, if you understand, it becomes a lot easier to do this stuff. Why do we do the non-business first? Review.
Because I think you can deduct it from your tax otherwise payable in your business section.
The word's a little off, but effectively the non-business number goes into the business one. So by definition, you have to do the non-business one first. Right? If you're going to see in a second, the number we come up with here goes into the calculation of the non-business one tax credit. So logically, you have to do the business one first. Everybody okay? Makes sense? Okay, so who wants to try their hand at the non-business foreign tax credit? Anybody? Anybody? Somebody I haven't heard from? Somebody I haven't heard from? Somebody who signed the list? Sherry?
So first we'll have to calculate tax otherwise payable.
Okay, so we're going to do the lesser of, right? Sherry? It's the lesser of first, right? So the non-business foreign tax credit, there's a lesser of calculation.
We don't have that.
Okay. Okay. The first parameter on any deduction is always going to be the amount paid, right? Think about anything you're going to see in a deduction. The first parameter has to be amount paid. So you're going to say lesser of paid, which is, Sherry, how much did they pay in non-business tax?
3,000.
3,000. Okay. So they told us they withheld 3,000. And then the second one, that's probably where you're going with this one, Sherry.
Yeah, so I started with tax otherwise payable.
Pardon me?
I started with tax otherwise payable.
Slow down. Come back. Before you even do the tax otherwise payable. Tax otherwise payable is part of the calculation, but let's do the first part first.
I don't think I did it right.
Okay. Okay. Somebody I haven't heard from. Jennifer, hang on. Somebody I haven't heard from. I mean, this isn't, I mean, it's in the book. We've seen it a few times. Yeah. I'll get you next show. Yep.
Calculated, you have to get the income from, so that'll be the income from UK.
Okay, UK income over Division B income less certain Division C deductions times tax otherwise payable. Top equals 1. Tax otherwise, sorry guys, wise. Okay? So, and I'm saying the top one. Okay, so there's 3 different concepts here I want to just talk about real quickly. Problem is that's why I keep getting behind, because I actually try to explain this stuff. Okay? Top one, tax otherwise payable. I put top one. Why is it top one? Why do I call it top one? Anybody read her today? Ready?
This is different for your
Right.
business.
Okay, remember, tax otherwise payable for this foreign tax credit is slightly different from tax otherwise payable for the business tax credit. So I'm going to call that a one. I'm going to be really creative. Top 2. Okay? And then we're going to talk about why they're different in a minute or so. Okay, so basically, what is this calculation? The second parameter is item 2. So the first one is your foreign tax credit is limited to how much you pay, and secondly, some other calculation. What is this calculation meant to do? You understand what it's meant to do, it becomes a little bit easier to figure out how to do it. I can assure you that. What is this calculation trying to do?
It's meant to basically give you a tax credit for Canada's tax rate applied in the country.
Right. Okay, that's absolutely correct. I'll say it a little differently, but you're absolutely right as a concept. Basically, what they're trying to say is what proportion of your tax do you pay based on your tax return are you paying based on the income, this foreign income? That's what you should get as a credit, as a limit. So basically, if the percentage of Canadian tax rate is 30%, or 20%, in this case it's about 20. So 20% of the amount of income. So if your UK income is 20% of your income and the tax rate is 20%, right? Basically, you should have 20 times 20, which is what, 4%. 4% of your total taxes payable is a credit. So let's do the math real quickly. So UK income as a percentage of all of your Division B income is a certain percentage. What that's trying to say is that's how much income, that's the proportion of income that you should basically say is the UK. And what we take is that percentage and say how much tax are we paying, tax otherwise payable. That should be the limit of the amount of tax you can take as a foreign tax credit. Because if you can remember, if you go if you're investing in Sweden, let's say, their rate was 50%. The amount paid might be $7,000. But the problem is that's at 50%. What if the Canadian rate's only 20%? Is the Canadian government going to say, okay, take a credit for $7,000 when you only pay 20% on that income in Canada? No. So they have to have some way of basically limiting the amount of tax that we'll give you credit for. The way they do it here is basically saying UK income as a percentage of all Canadian income, which is Division B, times the amount of tax you pay in Canada, is basically the percentage, the effective rate of your income tax. That's the maximum credit you're going to get. So in my example, let's say the UK income was $2,000 and all of our income was $10,000. So the UK income was 20% of our income. You should not get more of a foreign tax credit than 20% of the taxes paid. So if your total taxes paid is $10,000, you should only get a foreign tax credit of $2,000. You pay 10, UK income is 2,000, over 10,000 the total income, you should only have a credit of 2 over 10 times 10, which is $2,000. Problem is, see that's lower than the pay, tough luck. There are no carry forward provisions for the non-business foreign tax credit. You chose to invest in a high tax country, that's your problem. You can't get a credit more than what percentage of income you get. Everybody get that? It's a little bit hard to explain sometimes. Just remember, UK income over total income in Canada is a percentage. That's how much income UK represents that you're earning across the world, times the amount of income tax you're paying to Canada. That tells you the percentage of income of Canadian tax you should get as a credit. Okay, no more. If you pay more than that in the UK, tough luck, Charlie. That's your decision. You eat that. There's a special deduction for that extra, but I'm not going to talk about that right now. Okay. Does that make sense as a concept? That's all we're doing here. So basically, the UK income, who was doing this calculation? Who was doing the income calculation? Who was helping me with that? Okay. Are you?
Yeah.
Yeah. Okay, go ahead. Sorry, that was a while ago.
Yeah.
So UK income was how much?
UK income was
20. Okay, over Division B income, which we know was 305 up here. Here. 305 minus certain Division C deductions. What deductions are those? Anybody? Belinda? Minus dividends. Minus net capital loss, right? Okay, so that says 305 minus dividends deducted minus net capital losses deducted. Okay, which are certain Division C deductions. Anybody know why? Why do they do that? Okay, why do they take out a couple things on the bottom there in your denominator? Yep, Shirley.
Because you don't pay tax on them anyway, like the dividends are deducted.
Absolutely right. They're effectively in and outs, right? Take a look what happened up here. Canadian dividends here went in at +5. They went out at 5 here. So in the Division B income number, you have sort of a fictitious number because it's coming back out again. So it's a dollar for dollar income inclusion deduction. So the government's saying, we don't want that disputed result. That's the problem is if you have all this going on, you have foreign income, and in 1 year, you have $1 billion dividend from a company in Canada. Basically, what would happen is that $1 million income inclusion goes into Division B and screws up that percentages. So all they're saying is, that's not really subject to tax under Division B, really, because it's coming back out again, the next line. So what they let you do is, where there's a one-to-one deduction, so dividends come in, dividends go out. Taxable capital gains go in, net capital losses come out. They're not really being exposed to tax. We'll kind of give you the benefit of the doubt. We're going to take them out of the denominator, right? So remember, this is a good thing. When you take a number out of the denominator, that's making the denominator a lower number, right? This number is lower, and therefore the percentage of income tax that you get to take as a credit is higher. Everybody agree? Everybody understand? Okay, the book talks about this as well, so try to listen to the lecture, try to read the book again if you don't understand the concept. But the long and short of it is, these are two types of income that really, in the 305, they're really in and outs. So they're going to give you the benefit of the doubt and take it out. Okay, so that's going to be equals 20 over 305 minus dividends of 5 minus net capital losses of 6 times top 1 times, what's top 1? What's tax otherwise payable? So remember, this is basically the amount of Canadian tax the federal government's taking, that they're saying, we'll allow you to take a percentage of that, proportionate share of that as a credit, no more. Okay? Sure.
It's the taxes payable less the federal abatement and then less the general reduction.
Okay, so federal tax gross, federal tax minus the abatement. Oh boy. Minus the abatement, minus, pardon?
The general reduction.
Right, so let's do that, right? So we're going to have to do 3. General rate reduction, GRR, okay, which is?
It's 11.5% of 194,000.
Which equals?
I just did a couple calculations together, so.
What's 11.5 times 11.5% times 194? Somebody have that number real handy?
22,310.
22,310? Like that? Okay, so basically we're going to do 20 over 305 minus 5 minus 6 times, what's the numbers here, 17. Yeah, here we are here. So it's 73, 72. Make sure I get these 73. 73.72 minus, what was the abatement? 12.
13,580.
There it is, 580, yeah. Minus the GRR, which is 22.31. Okay, so 20 over, so your UK income over your Division B income as adjusted times your tax otherwise payable, which equals 2573. Right? And then the lesser of 3,000 and 2573 is 2573, right? So this number here. Okay? There is method to the numbers, you just have to learn it, okay? Okay, if you understand the concept, it becomes a little bit easier to come up with the calculations. Okay, what do we do now? What else we got next, guys, ladies and gentlemen? Karen Deep?
Do your business
So foreign business, FTC. Okay, Karen Deep, go ahead.
So that would be the lesser of three things.
Remember, least of. Lesser of two, least of three, right?
So the first would be the tax that you actually paid.
Chief Gold?
16,000.
Yep.
And then the second one would be.
Hang on. Remember, foreign business tax credits, you can carry them forward 10 years. Back 3, forward 10. In this case, they told us there's a 3 carry forward. Plus 3 equals 19. Okay? Remember, foreign business, the whole idea there was the business can go up and down, so they let you kind of smooth out your foreign tax credits over time. That's why there's carry forward provisions. And they couldn't make it 3 and 20 to make it equal with everything else. They made it 3 and 10. So, don't ask me why. Okay, so it's the least of 19, which is basically the amount paid plus carry forward. Karen D plus what else?
So then you do your income earned.
Remember, you have to do a foreign tax credit for each country. So each country, and secondly, each type of business, each type of income, business and non-business. So if you have 10 different businesses and 10 different countries, you have 10 different foreign tax credits. Okay? Because they want to make sure that you're taking a percentage of each country and limit it to the Canadian tax rate. So if you have one high rate, one low rate, they don't blend. You do a different foreign tax credit for each country. Okay, so it's going to be the same calculation, income from U.S. over star above. Okay, I'm just going to put star above. Is that okay, Karen D? Because it's the same calculation. So this number here. Okay, so that denominator is the same for both calculations. Okay, so this star here, I'm just arrow it, okay? So I'm going to put this. Come on. Jesus, slow. Right there. Okay, so that denominator is the same for both. Times top 2, right? So top 2 is different from top 1. Okay, so let's do the math there, Karen Deep, real quickly.
So it would be 100,000
Yep.
over same thing, so 305 minus 6 minus 5.
Yep.
And then your top 2 would be your federal taxes minus your general rate reduction.
Okay? So basically it's the gross federal tax minus the general, no, sorry. Did you say minus the abatement?
No, the general.
Right, that's better. Right, so we have those two numbers, which equals 100 over, what is that, 294, all times by, what are those two numbers, 73, 72? 72 minus 22.31. That's up here, right? What's that number come out to be? Do you know, Karen D?
17,486.
Yep. Okay. 17,486. Okay. Why are top one and top two different? Jennifer.
Option doesn't have the abatement because the abatement is only equal to income from the province, so if you have business income, then it wouldn't have been earned in the province essentially.
Okay. Remember we did that abatement calculation, and we gave the abatement to the income that was subject to tax in the province. This is U.S. income. It wasn't subject to tax income. It wasn't subject to tax in the province, therefore there was no abatement. Therefore we should not reduce the abatement. We should not reduce the amount of federal tax here. Remember, a minus here is bad, right? Because what that does is it reduces the amount of federal tax that you're taking a percentage of, a portion of, to determine the maximum credit. So what happens here is, there was no abatement on that income when we did the abatement calculation. To be fair to this foreign tax credit, there should be no abatement reduction in the tax otherwise payable. Okay? Makes sense? Jeanette? No, German, you know. Got it? Okay. Just left a little bit. It's okay. Okay, so try to get the concept because they match up. There's abatement on the provincial income. The abatement reduces the foreign tax credit for that type of non-business income because it's going through the provincial incomes. The federal or the foreign income, the foreign business income, there is no abatement. Therefore, there should be no abatement reduction when you calculate the foreign tax credit. It's fair, right? They've got to be symmetrical. Okay. Okay, and 3, the least of.
It would be your top two, subtract the non-business tax credits.
Right. So you can do 73.72. So this top two here is going down here. Minus your foreign non-tax credit, which was minus 22.31. That's your top two. All minus your foreign non-business tax credit, which was 2.573. 73. You know the number, Karen D? 48,837, like that. So the lesser of is clearly 1746. We done? So we've done the foreign tax credits, we've done the abatement, blah, blah, blah. Jeremy?
You have a general rate reduction.
Good. Don't forget, we already did the calculation for the general rate reduction. We just didn't do it yet. We didn't put it in here, which was how much? 22?
It was 11% times 194, so 20,310.
Right, which we already did over here, right, Jeremy? We did it here. 22,310. Federal taxes payable is 17,771. And then you're going to do BC, Alberta, total. So BC was 77,600 times 10%. They told you the rate was 10%, which is going to be 7,760. What the heck's going on here? Alberta is going to be, we just took the taxable income here, 58,200. So 58,200 times 10% is 5.82. You can add those up and you're going to come up with 31,351. Okay? So all we do is we already calculated down below here the BC taxable income here and here in Alberta, and all we're doing is multiplying by 10% and adding it to the bottom of the tax bill here. Okay? Federal tax payable of 17, BC is 7,760, Alberta is 5,820, total is 31,351. Okay? Yeah, Jennifer?
So, for the unused, tax, we have an unused foreign tax credit, that only comes into play when we do the lease stuff.
Sorry, which one? Sorry?
When we have the unused foreign tax credit.
Right, 'cause right here, there is a carry forward, right? And so if you wanted to note, if you wanted to get, there'd be an extra mark down here where you would note that the foreign business tax credit, remember we had 19 carry forward here, we could only use 17. So somebody note unused carry forward equals to 1,516. And that can be carried forward 10 more years, right? Because you'll use the 3 that's carried forward first, and then we'll have 10 more to use on the new one that we paid this year for 16. Okay? Everybody understand? So remember, there's carry forward with the foreign business for 10 years. What you're going to do is you're going to use the first 3 that you carry forward to this year, and then so this carry forward number, the 1,516, will just basically have 10 more years to go. You're just going to be generating. Okay? Good thing. All right, some tough slugging there, but yes.
Sorry, can you tell me how the 1,560?
Oh, sorry. So you had $19,000, and then we only could take 17,486.
Oh, okay.
Remember, our deduction was 17,000. This was the deduction amount. Deduct 17. We had 19 available, so the difference between 19 minus 17.486. Okay. So available of 19, deducted 17.486, you can therefore carry forward the difference. I hope, did I add that right? I hope it's right. 15, 16, right? All right, some tough slugging there. And again, in 18 months, it becomes even more complicated. A lot more complicated. So I suggest we got to try to learn this stuff because you couldn't see in 18 months. When you start putting small business deductions and stuff like that, they all start kind of mixing all over the place. Because remember, you can only have small business deduction, an NMP deduction, or a general rate reduction, so they're all tied together. So when we start looking at small business deduction in 462, obviously they're all intermingled. So the calculations become a little bit hairier now. So this is the easy one. Okay? So you got to know how to do this stuff as you go. Okay? Everybody good? Well, what happened to that bottom number there? Disappeared again. Eh? What was that number? 837. With the ghost taking that number away. 48,837. Okay, so what we got to do is we're going to do some R&D stuff, okay? So do 415. Okay, before we do the question, okay, some fundamental things you need to understand, okay, on R&D. Okay, remember, it's a pool. Okay, all of this is a pool, much like your CCA pools. You put expenses in, you take deductions out, you take 19Cs out. That's it. Right? We're going to see that. Okay? So whatever you do from an accounting point of view, this question, all you have to know about question whatever what number the first one we're doing, 415. Whatever you do from an accounting point of view for R&D, add it back, and then you're going to deduct the tax stuff separately. Okay? That's it. So look what's going to happen here. So So 415, here's the required. Based on the above information, explain to the accountant the adjustments necessary in computing income for tax purposes for the years ending December 31st, 11, and 12. Okay? So all we have to do is explain to them what the difference is. So this isn't a long question. This is very much a conceptual question. But you got to know how to do this stuff because this is fundamental to understanding R&D accounting. Okay, so you go back to question 15, bless you. Talks about Joe's Widgets Company, R&D. Up here. It's a Canadian controlled private company. They've determined net income for tax purposes of $615. So somebody's already done this, get the reconciliation, including CCA. And then they give you a bunch of information. R&D expenditures are as follows. The lab machinery is 100% for R&D activities. If a capital asset is used 100% for R&D activities, what do you do with it? Jeremy?
100% deduction.
Okay? Remember, it goes into the pool and therefore is fully deductible. Okay? That's the easiest thing to remember. And that's the only type of capital expense you can deduct like that. So it's very special treatment. You spend $1 million on a capital asset, you could deduct it. That reduces your taxable income real fast. Right? Okay? Normally you have to amortize that on your CCA schedule. Okay? So this is, and you'll see here in this question, kind of odd that they basically bring in the concept that there's 35% ITC rates, right? Whereas a company is eligible for investment tax credits at 35%. They correctly determine the eligible investment tax credits as follows. Okay? So what we want to do is, let's just go to this part. Here, this is where they basically tell you, this is how the accountant did the accounting for it, right here. Okay? This is what the accountant did. Okay? So the lab machinery and equipment, the gross amount was $450,000. They're eligible for a 35% ITC. And remember I told you in a couple of the next 18 months now there's a 35%. I don't know why they brought it into this question. They should have left it at 20 to keep it simple, but let's use the 35. So what this accountant did was took the lab machinery equipment for $450,000, took off the ITC, recorded the asset for $292,500 as a capital asset. Okay? That's what they did. What you normally do, right? The capital asset, that's what you do for accounting. The accountants don't care what the tax people do and vice versa. Except when you come down to future input taxes, which then you get to understand both. Okay? Building, gross amount was 120. They recorded 120. When you say building and R&D, what are you going to say? Okay. Okay. Does it go into the pool? Buildings are specifically excluded. Okay? Except for what they call special purpose buildings, and I'm not going to. I've never seen one, I don't know what it is, so I'm not going to ask you about it. Okay? Just remember, buildings are not R&D expenses for the most part. Okay? Salaries for lab staff, they had $100,000 gross amount. You took off the ITC, he or she took off the ITC and recorded wages of $65,000. Okay? They reported the net expense of $65,000. And then lastly, operating costs, they did $40,000 of expenses, reported the ITCs as a reduction, and then therefore had an net accounting expense of $26,000. Okay, that's what they did from the accounting point of view. What am I going to do from the tax point of view? What am I going to do from a tax point of view? So tell me. Okay, so they told us the starting point for this question is net income per tax, excluding R&D expenses. So assume everything else is right. So take the CCA, they've taken everything correctly. Okay? Your starting point is net income per tax of $650 before R&D. So this person's got a lot of tax returns, and they said, hey, I get all this stuff, but help me, I'm screwed up on this R&D stuff. What are you going to change? How are you going to reconcile the 615? What is it, this person, what are you going to give them a schedule that shows? Anybody want to come? Walk me through. What did I say before? What did I tell you?
It's wrong, so you have to add things back to bring it after accounting income in order to take the deductions for the things that they actually covered for.
Right. Reverse what you did for accounting and do the right tax. That's all you're going to do. Okay? Just like any reconciliation of accounting income versus tax. Reverse what the accountant had done incorrectly, for lack of a better expression. So in this case, lab machinery equipment, is there any effect on income so far? Was there any adjustment for accounting income so far? No. Good.
Wasn't it amortization that they took?
Yeah, but what they told us, just assume the amortization is all about property in the accounting records. Remember, you're going to add back amortization anyway. Doesn't matter. So what you're going to do is, first thing you're going to say is, machinery equipment, there's no adjustment, right? Because it was capitalized for accounting. So we haven't screwed up. We haven't taken a deduction. We haven't taken a deduction improperly. So so you're going to basically say machinery and equipment. So it's going to call this adjust accounting. We're going to say none. Okay? Because they haven't deducted anything from an accounting point of view other than depreciation, which you've already added back anyway, right? Building, same thing. They haven't done anything for accounting for building that's different from tax, especially this one. Because tax and accounting are going to be exactly the same. Capitalize it and amortize it. Okay? Now here's where you get the tricky part, right? All you're going to do now is, what did he do incorrectly, for lack of illustration? And all he's saying correctly, I'm being facetious and saying the accounting treatment is different from the tax treatment. Salary staff, what did they record as an expense? Janice? So you're going to add back salaries for lab staff, 65, right? That's the net number, right? So he recorded a $65,000 expense for salaries for people who are doing R&D. Add that back, and what we're going to do is we're going to do it down below. We're going to deduct what the tax people are going to let us do. Okay? Okay, what about the operating costs? Jeffrey?
Can you add that back?
At the net number, right, Jeremy? Okay, so look what we've done. All we've done is they took two deductions, one for 65, one for 26, add them back. Now we're going to say, okay, great. Okay, that's super. Now what we're going to do is, what are we going to do? So we added back all the expenses. Esther, what are we going to do? Okay, so what I'm going to put in section 37. How much was that?
450.
Yep.
And then salaries 400. And operating costs 400. Total is
Hang on, expenses available for here. Is that 590? 590, Esther? Okay, remember, it's a pool. You put it in, and if you need all the deductions, you take it out. So add up the amounts that you're allowed to deduct, put them in the pool. So that's what I said. If you start the year, they said this was new to them. So your opening balance of the pool was 0. Remember UCC pools? Opening balance was 0. You're going to add some stuff. You got your expenses available in the year. You're going to say take the deduction for the year, which is basically you can take anywhere from 0 to 590. So in this case, we're going to take the full 590 because we know they're taxable. We're going to take the 590. And all we're going to do is go up here. And we're going to take the 590 as a deduction. So take a look what happened here. The accountants took up 110,000. The tax people letting you take 590. That is a huge advantage if you're an R&D company. Right? Look what happened here to these people. The accountant said 100, 10, whatever the number was, 65 plus 26, whatever that number was. Yeah, the tax people were saying 590. Okay? So you're now going to come up with, what's that number work out to be? 160? Is that 2010 Division B income? 116. Is that okay? Everybody agree? So the key to remember is this pooling idea. Okay, put it aside. Reverse what the accountants do, and then put it into the pools, and you have to do the pools correctly. Because what happens the following year? Now what they're saying is they don't expect to do anything the following year in terms of R&D. What happens? So the following year, there's no R&D. Okay, they just said they don't have any R&D. What's going to happen to this company? This is when payback happens. What's going to happen? That's it.
You have to add back on credit.
Remember what happens? This is 2010. You get to 2011, the year following the year that you use investment tax credits, you have to include them on your tax return. Right? So guess what happens here? 2011, the first thing you're going to do is less ITCs used in prior year, which was how much? How much did we use the prior year? How much? What was the investment tax credits we used? Did we calculate those numbers yet? We did. It should be 35% times, what were the eligible expenses? It was, oh, there, yeah, sorry, you got it there. It's the sum of 157.5 plus 35 plus 14. What's that number work out to be? 206.5. Did we use all the 206.5?
I think you guys are 2011 and 2012.
Did we use the wrong years? The years moving around on us? What's the question say? Sorry. 415. So the year ended, oh yeah, sorry, 11 and 12, wrong year, sorry. So this is 2011. Oh, come on. So that's the end of 2011, Janice? And this should be 2012, sorry. Okay? Okay? So look what happens here. The end of the year, the balance was 0. Now all of a sudden they're saying you have to take out the ITCs used of 206,500.
The 206,500 is actually the maximum, or not like.
Correct.
The income was only 160, you can only claim it up to the point where.
Correct. So this should be less ITs, which is the lesser of. This is the pool balance. And 2011 tax is payable. Which equaled how much? That was the, have to do the calculation here, right? Division B income. So you'd have to do something here, 116 times an effective rate, right? 20%, let's say 20%. The solution doesn't do this all this well, that's why I'm doing it for you. It's, what's 20% times 116? Pardon me? 23.2. So really what would happen here is, right, your pool balance was 206, what was that number, Jennifer?
206.5.
So the pool balance was 206,500, but we only used 23,200 because the tax liability federally was, we assumed 20%, just pick a number, times the taxable income. Remember we came up with 116 here. Okay? 116 times 20%, so 23,200. So 23,200. Now the kicker here is, that's now negative. What happens? What happens when it's negative? Okay. Just like CCA, negative balance, you got to give the money back. Basically, the government, as far as the government's concerned, you've taken too many deductions. You have to basically income inclusion. In 2012, of 23,200 goes back to 0. The same concept happens as CCA. It goes negative, you have to have an income inclusion because it's always going to go back to 0. You cannot have a negative balance at the end of the year. Okay? That's the key here. Okay? So that's the whole key to this question is, The pool concept, they're limited on the ITC, and even the textbook actually didn't do this. It's pretty funny, they didn't even figure that out. But suffice it to say, you can only take the lesser of the ITCs available and the tax liability. So we have to basically assume, let's just assume 20% federal tax rate. Okay? So we only had taxes payable in 2011 of 23,200. So the ITC, the maximum we took that year was 23,200. So that's the number we used, not the full 206,000 pool balance. So we actually have ITCs carried forward of 206.5 minus 23.2. You can carry those forward 20 years as well. Okay? Sure.
Can you explain why no adjustment was made to the machinery and equipment?
Which one, sorry, no adjustment was made for machine and equipment, what do you mean?
At the very beginning, like, there was no adjustment.
Because from an accounting point of view, the accountant capitalized that machine and equipment, basically, and took the ITCs off instead of putting, so they put it on the books for whatever the question is. Where's the question here? So that machine and equipment, they put it in the assets at 292,500 and are depreciating it, right? So when you do your scheduled reconciliation of division and income, you add back depreciation anyway. So it's a non-issue because we've already added back all the depreciation.
Also, it's assuming that 615 already includes the.
Yeah, 615 already includes all your depreciation, amortization, whatever they've done properly. That's all that. So we've already added back and getting up with the 615. And now what we're saying now is, but from a tax point of view, you get to write it all off. So there is no adjustment from an accounting income point of view because you need to deduct it from an accounting point of view. You put it into capital, you put it into the fixed assets. Okay? Everybody get that? Does that make sense? Gentlemen? Ladies? Okay. So we have one more question on Thursday. What we'll do is we'll start with that. It'll take us 10 minutes. Then we'll do ITC, our agency GST, and then we'll review section any questions you have. Okay, so if there's a question or two that you want to think we can review in class, email me and we'll see. Talk to your friends if it's the same question, and you can probably get that one. Sure.